If you're investing money without following this specific order, you could be leaving over $100,000 on the table throughout your career. I'm going to show you the exact hierarchy that wealthy people use to fund their accounts, maximize tax savings, and build wealth faster than 95% of investors. Let's dive in. Here's the problem. Most people know they should be investing, but nobody teaches you which accounts to fund first. Should you max out your 401k, open a Roth IRA, build up a brokerage account? The order actually matters tremendously, and getting it wrong costs you serious money in unnecessary taxes and missed opportunities. Let me walk you through the optimal investment hierarchy step by step, with real numbers you can use starting today. Step 1 is absolutely non-negotiable. Contribute enough to your employer's 401k to get the full company match. This is the closest thing to free money that exists in finance. If your employer offers a 50% match on the first 6% of your salary, and you earn $60,000 a year, they'll contribute $1,800 annually if you put in $3,600. That's an instant 50% return before your money even gets invested. No stock, bond, or real estate investment can guarantee that. Most companies offer matches between 3 and 6%, with the match ranging from 50 to 100% of your contribution. Check your employee benefits portal today and make sure you're getting every dollar of this match. Step 2. Before investing another penny, eliminate any high-interest debt. I'm talking about credit card balances charging you 18 to 29% interest. If you have $2,000 in credit card debt at 22% interest, you're paying $440 per year just in interest charges. No investment consistently beats 22% returns, so paying off this debt is technically your best investment. Focus on anything above 7% interest before moving to the next steps. Step 3 is where things get interesting, the health savings account, or HSA. This is the most tax-advantaged account that exists, yet 70% of eligible people don't use it. Here's why it's incredible. Contributions are tax-deductible, the money grows tax-free, and withdrawals for qualified medical expenses are tax-free. That's a triple tax advantage. For 2024, you can contribute up to $4,150 as an individual or $8,300 for a family. You must have a high-deductible health plan to qualify, which means a deductible of at least $1,600 for individuals or $3,200 for families. Here's the strategy. Max out your HSA, invest it in low-cost index funds through providers like Fidelity or Lively, pay your current medical expenses out of pocket, and save your receipts. You can reimburse yourself decades later, tax-free, or use the money for healthcare and retirement when expenses typically increase. If you contribute the family maximum for 20 years with a 7% return, you'd have over $400,000 growing completely tax-free. Step 4. Open and fund a Roth IRA up to the annual limit of $7,000, or $8,000 if you're over 50. Roth IRAs are funded with after-tax dollars, but all growth and withdrawals in retirement are completely tax-free. If you invest $7,000 annually for 30 years with an 8% average return, you'd have over $860,000, and you'd pay zero taxes on withdrawals after age 59 and a half. Plus, you can withdraw your contributions anytime without penalty, giving you flexibility that traditional retirement accounts don't offer. Fidelity, Vanguard, and Charles Schwab all offer excellent Roth IRA accounts with no account minimums and low-cost index funds. Note that income limits apply. For 2024, eligibility phases out starting at $161,000 for single filers and $240,000 for married couples filing jointly. Step 5. Now go back and max out your 401k beyond the match. The contribution limit for 2024 is $23,000 or $30,500 if you're 50 or older. This money grows tax-deferred, meaning you don't pay taxes until retirement when you're likely in a lower tax bracket. If you're in the 22% tax bracket and contribute $23,000, you save over $5,000 in taxes that year alone. Step 6. Once you've maxed out all tax-advantaged accounts, invest in a Regula, our taxable brokerage account. While you don't get tax deductions, you have complete flexibility, no contribution limits, and favorable long-term capital gains rates of 0 to 20% depending on your income. Use tax loss harvesting to offset gains and focus on tax-efficient index funds. Here's your action plan. Calculate what percentage gets you your full employer match and set that up today. If eligible, open an HSA through your employer or a provider like Lively. Open a Roth IRA at Fidelity, Vanguard, or Schwab and set up automatic monthly contributions. Work toward maxing your 401k as your income grows. Following this order could easily save you $100,000 or more in taxes throughout your career while maximizing your wealth-building potential. The difference between doing this right and doing it wrong is literally the difference between a comfortable retirement and financial stress. Which step are you working on right now? Let me know in the comments and subscribe for more strategies to build real wealth.